Hey traders, Jason here from Levitt Brothers. So let's talk about the state of the market. Okay, it's weak, it's trending down, we're in a bear market. I actually called the market a bear market back in January. We weren't technically in a bear market because you got to be down 20% in order to meet that qualification. But based on what I was seeing, based on how it was acting, the market's personality, the character, the weakness below the surface, I said in January the market, we were already in a bear market, and the top was in, and it was going to be all downhill from there. And that's pretty much what's happened. Here we are, like 5 months later. We put in lower highs, lower lows. We've broken a few support levels. We are, call it whatever you want, bear market, this market, that market. Bottom line is we are in a downtrend. The uptrend is over. A top is in place. The market is trending lower. And based on what we see out there, this probably is not going to be just a rank and file correction within an uptrend that's going to find a bottom soon and then resume its uptrend. This is going to be something that's much worse. Okay, I'm not going to go out there and say this is going to be as bad as the .com fallout or the financial crisis. I'm not going to be that extreme, but I do think it is going to be significantly worse than just a normal bear market within an uptrend. And when I say a bear market within an uptrend, is you have secular uptrends that could last 15 to 20 years, but within those secular uptrends, you could have mini bear markets along the way. I don't think this is going to be a very normal bear market within a 15 to 20 year bull market. I think this is going to be a big bear market that goes down much further than 20% and lasts a lot longer than just 5, 6, 7 months. All right, so what I'm going to do today, we're going to look at some of the indexes. I'm going to give you a little bit of, not hope, but give you a little bit of a perspective with some stats, and then we'll look at some of the indicators. All right, so let's get into it. So here is the S&P 500. That over here is the COVID bottom. You can see support from the 21, 21, 21. My moving averages here are the 8, the 21, and the 50. Support from the 21. Same thing here, same thing here, same thing here. Then the index broke down. It bounced. It failed, and then it fell further. So the way I see this is I see the index breaking down from a rising trend line, as you can see, moved down, tried to move up, got above some key moving averages, but failed. And now here we are down 7 weeks in a row, which doesn't happen very often. So to me, the uptrend is over. Lower highs and lower lows are in place. A downtrend is in place, and the market is going to go probably much lower. Okay, we're due for a bounce. Certainly, we got some bottoming tails on these candles here. 7 weeks in a row, as I said, doesn't happen very often. We are definitely due for a bounce, but even if we do get a bounce, I think best case scenario is we just bounce 10 or 12 or 13%, and best case scenario is we just kind of do something like this, and worst case scenario is we actually bounce and have some sort of pattern before we go much lower. That is the S&P. Let's look at the NASDAQ. So NASDAQ is similar, actually worse off. So we have uptrend here, broken. Index moves down. I should say it moves down, gets rejected by the 50, moves down, gets rejected by the 50, and is now down a bunch. Let me get rid of some of those trend lines. I could redraw a trend line kind of like this. Okay. So again, to me, a top is in place. The uptrend is over, not just the uptrend since the March 2020 low, but the uptrend that started back in 2009. Okay. We had a 13-year, 12-year bull market that had some interruptions along the way. That is over. Okay, a top is in place. That's over. We're in a bear market, and this is going to last longer than just a few months. This is going to be more painful than just a normal pullback within an uptrend. Even if we get a 10% rally here, it only takes us back to this former support level and to the 8 moving average. And if we get a little bit more off, after that, then we're going to bump into the 21. Okay, so this is the perspective here, okay? Uptrend over, downtrend in place. There will be bounces along the way. Here is the S&P 500 2-hour chart with a 50 moving average on it. I only show it for perspective. You can see that for 2 months, the index has been trending lower, lower highs, lower lows, obviously just channeling down. It got above the 50 there, but lost it quickly. Got above the 50 there and lost it quickly. Same thing here. So the market bounced nicely on Friday afternoon into the close, but unless we can get above the 50 here and at least hold above it, maybe come down and test it, we should treat all rallies like they're just bounces within downtrends. Now, if we get above this 2-hour 50, then we might have a little bit better of a rally, okay? So initially, we're just looking for a bounce within an uptrend as a possibility. And if we can get above the 2-hour 50, then maybe we can get a move that lasts 2 weeks, 3 weeks, rather than just 2 or 3 days. The NASDAQ is similarly set up, as you can see. Support from the 50 there, but rejected there, rejected there, rejected there. So even though we have the potential for a double bottom here, unless we get above the 2-hour 50, don't trust it. All right. So in my opinion, just to kind of sum it up, is like the uptrend that started, the bull market that started in 2009 is over. A top has been put in place. The market is trending lower. We're in a bear market. It's going to go much lower, but we have to remind ourselves that within bear markets, there is a tendency to get big moves. There's a tendency to get big single-day moves, and there's a tendency to get big multi-day or even multi-week moves. So here are a couple stats to consider. Okay, so under the heading of bounces within bear markets, 9 of the S&P 500's top 20 single-day rallies came during the 86% drop off the 1929 top. Okay, so 1929 tops, we're talking about the Great Depression. The S&P 500 dropped 86%. Of the 20 single-day best rallies in history, 9 of them came during the Great Depression. So bear market rallies that like huge single-day moves take place within bear market rallies all the time. Next one, similar stat for the dot-com era. 12 of the NASDAQ's top 20 single-day rallies came during the 78% drop off the dot-com top. Okay, so you got a dot-com top in 2000. The NASDAQ eventually dropped 78%, but of the 20 biggest single-day rallies that have ever taken place for the NASDAQ, 12 of them took place during the 78% drop. Okay, so even when the market is falling and falling and falling and we're in a huge bear market, there is a strong tendency to get big single-day moves. Next up, a couple more numbers. After the 1929 top, even though the Dow fell 89%, there were 10 bear market rallies that were greater than 10%, with the average being 22.8%. Okay, so we got 1929 top, good, heading into the Great Depression. The Dow fell 89% over the course of a couple of years, but there were 10 bear market rallies that were greater than 10%. Okay, so even though we had a multi-year bear market where the market fell 89%, there were still 10 rallies that went 10% or more. Okay, so that's huge. Whoops. Okay, next number is after the 2000 top, even though the NASDAQ fell 78%, there were 16 bear market rallies that were greater than 10%, with the average being 22.7%. Okay, so we're talking 2000 top, dot-com bubble. The NASDAQ fell 78% over the course of a couple of years, but there were 16 rallies that went 10% or more. Okay, so this is just a little bit of a reminder that even though we're in a bear market, even though this is going to be very painful, even though there's going to be huge losses, there already have, and there are going to be continue to be more, there is still high odds that there are going to be multiple 10% moves along the way. Okay, so keep this in mind as we go forward. When you think like, my goodness, this thing can't bounce, this thing can't rally, there are no there are just no bulls, there are no buyers, there's no nothing. When you think that the market just can't do anything, don't be surprised if we get one of those surprise 10% moves. Okay. Now let's look at a couple indicators that support the idea that maybe we're like in the beginning stages of one of those moves. Okay. So this is the S&P 500. And what you see, the three charts below are the 10-day, the 20-day, and the 50-day moving averages of the NYSE AD line. Okay, so divergences between the AD lines tend to call market reversals. Okay, for example, and I'm not going to go through all of these. So over here we had market moving higher highs, higher lows. The 10-day moving average of the NYSE AD line had put in a lower high. The 20-day also had put in a lower high. And what did the market do? Initially it fell, and then it moved sideways for about 5-6 weeks. Okay. Over here we had market putting in a lower low, and we had higher high from the 10-day, or higher. We had higher low from the 20-day. And what happened? The market turned around and rallied. Okay, so we get pretty good signals when you get a divergence. So what we have going on right now is we have a lower low from the index, but we're starting to get some higher highs from the 10-day and higher highs from the 20-day. Okay, so we're starting to get some beginning signs that, market was really weak when it did this, and then when it did this last week, it was bad, but it was less bad than the week before. So we're starting to get a divergence, which tells me maybe we're in the beginning of, this was a 10% rally. Maybe we're in the beginning phase of getting another 10% rally. Next chart, this is the S&P 500 versus the 10-day, 20-day, and 50-day of the NYSE 80 volume line. Okay, so the 80 line lets all stocks speak equally. The volume line lets the higher volume stocks do more of the talking. Divergences work here too. I'm not going to go through the details of the chart. You can pause the video if you want to look at it. We're getting the same type of signal right now. Lower low from the index, from the S&P 500. We have a higher low from the 10-day, a higher low from the 20-day, and we've gotten a couple higher lows from the 50-day. So we're starting to see a little bit of, the situation isn't good, but it's less bad than it was before. Okay, and you can see what happened over here when we had divergence right there. This is technically not a divergence, but mostly, for the most part, other than the one low here, you do have a divergence. So, and you can see what happened with these higher lows here, and then that led to a pretty decent tradable rally. Okay, let's go to the next one. So here is the S&P 500 versus large cap, mid cap, and small cap new lows. What you have here is a lower low for the S&P 500, but in all cases, less new lows were put in place. Okay, so let me delete those. So on this low, we had this many lows, this many lows, this many lows. And then last week we had a lower low, but we had less new lows, less new lows, less new lows. So the situation was still bad, but it was less bad. So we have positive divergences forming here, which tells you that sellers are a little running out of energy here. They tried to push it lower, but a lot less stocks printed new lows. Okay, so like over here we had 130 stocks print new lows. Over here was only 60. So there was that many less stocks printed new lows on this additional push last week. So it tells you that sellers are running out of energy. Here is the S&P 500 up top. What you see down below is the 1 month Russell 3000 high low. Okay, so what you have here is, over here you had S&P 500 making lower lows, but the Russell 3000 1 month high low was putting in higher lows. Okay, so you got a low here and a low here. You got a lower low, but this is less bad. And then you basically have the same print here, and it's less bad again. So it tells you like the market's trying to push lower, but each of these prints is less bad than the one before. And then what do you get? You get a pretty decent rally out of here. That's what we're getting right now, starting to get right now. So you got a lower high there or lower low there, okay? but we got a print here, and this is a lot less bad than the previous print. Okay, it doesn't mean the market's strong. It just means it's less bad, which is at least a step in that direction. Okay, so just to wrap up quickly, market's in really, really bad shape. Okay, top's in place, downtrend is in place. We're in a bear market, and it's going to get much worse. But remember that big single-day up moves take place in bear markets, and there is a strong tendency that even within a bear market where the market falls, posts a huge, massive loss over the course of several years, there are still many, many, many 10% bounces. And given the divergences, the positive divergences that I'm seeing in place, there is at least a good possibility that we might be in the beginning stages of one of those 10% rallies. All right, hope you got something out of it. Give the video a like, share it with your trading friends. I'll see you next time.